Hello and welcome to the virtual classroom, where in this video, we are going to walk through several examples of journal entries from start to finish. We're going to look at several questions that we need to ask ourselves before we can even properly record our journal entry. So let's look at the first transaction. On December 1st, we have Jay Cool investing $40,000 cash into his company, Cool Kicks. So here's the first question. What two accounts are involved in this particular transaction? So every transaction has at least two things going on. Now, it could be three, four, five things going on, but there have to be at least two things going on. Both of them can be going up. One can be going up and the other one can be going down. That part is not necessarily important at this point. At this point, we just need to determine what two things are involved. So we know that J. Cool is investing money into the business, and we keep track of investments through the capital account. So we have J. Cool Capital. And what is he investing but cash? $40,000 in cash. So these are my two accounts involved in this transaction. Let's move on to question 2. What types of accounts are involved in this transaction? So J. Cool falls into the equity category, specifically capital. And that's going to be important for my next question when I have to determine the normal balance. Cash, well, cash is an asset. Keep in mind that assets are resources that we own or control. So when you see the question, what types of accounts are involved in this transaction, we're talking about, are these assets, liabilities, equity in terms of capital, revenue, withdrawals, and expenses. We need to categorize it so that we can make sure we use debits and credits in the proper way. So now that we know the types of accounts, let's move on to the next question. For the next question, what are the normal balances of these types of accounts? And I have a little chart here to help you to remember. Assets, expenses, and withdrawals all have normal debit balances. That means we're going to be using a debit to increase, a credit to decrease. Liabilities, capital, and revenues, well, these accounts all have normal credit balances, meaning we're going to use a credit to increase and a debit to decrease. So we're looking at credit for equity capital, or J. Cool, and we're looking at debit for cash. Now, that doesn't mean in this journal entry, I'm going to debit cash and credit J Capital. Doesn't necessarily mean that. Depends on which account is going up and which account is going down, which leads me to the next question. What should I do to increase or decrease these accounts? Well, this answer is basically the same as the normal balance question in terms of increasing, because we determine the normal balance of an account by saying, well, what do I have to do to increase the account? So for capital, to increase it, I use a credit. To decrease it, I use a debit. For cash, which is an asset, to increase, I use debit, but to decrease, we use credit. Now, here's the most important question of this whole thing. In this specific transaction, which account is going to be debited and which account is going to be credited? Because remember, if you debit one thing, you have to credit something else, because at the end of the analysis of a transaction, debits have to equal credits. As long as debits equal credits, then the accounting equation is in balance. Assets equal liabilities plus equity. So in this one, cash is going up. I know that cash is increasing. The business is getting more cash. Now, don't think about J. Cool as an individual. As an individual, yes, I know he's giving up cash, but I'm not doing the transactions for him as an individual. We're doing the transactions for his company, Cool Kicks, and his company is getting more cash. And J. Cool, we're keeping track of his capital account in terms of his investments, and that one is going up as well. It's okay that I have two accounts increasing. It's just that I use a debit to increase cash, and I use a credit to increase capital. So now that I know which accounts are being debited and which accounts are being credited in this transaction, we can get ready to properly record the journal entry. So here we go. I put black boxes around the information that we need because I'm asking myself these 5 questions just to determine which account should be debited and which account should be credited. But I want you to see that logical process that you will eventually go through in your head as you do these journal entries. So every journal entry has to have a date. So we list the date first. The account that we are debiting goes first, and we are debiting cash for $40,000. So we list cash and the $40,000. The account that we are crediting is listed second, and it must be indented. That is the only way we know that this account is being credited, by the indentation and the fact that it is listed second. We also move the number over into the other column as well. So don't align the number with the debited amount. It should be in a separate column so that we know that we're crediting J. Cool Capital for $40,000. And you can't forget the explanation. This is where you can finally be creative. You can say owner invested cash, you can call it owner investment, but this is just a brief summary of the transaction. Now, let's look at another type of transaction. On December 1st, again, Cool Kicks purchased equipment for $5,000 cash. So again, we ask ourselves the first question: what two accounts are involved in this transaction? We have equipment and we have cash. The company purchased equipment using cash. The next question: what types of accounts are equipment and cash? Well, both of these accounts are assets. These are resources that we own and control. And a transaction can have two assets. It's just that one better be going up and the other one better be going down, because remember, debits have to equal credits. So let's look at question 3. What are the normal balances of these types of accounts? So we know that all assets have a normal debit balance. So we list debit for that one. Now, the next question: what should I do to increase or decrease these accounts? Well, with a normal debit balance, we use a debit to increase, a credit to decrease. So that's what we see here. And finally, we get to our 5th question that says which account is debited and which account is credited. This is where we determine which one's going up, which one's going down. And based on that information, which one should be debited, which one should be credited. So the company is getting more equipment. So equipment is going up, but we're using cash to get this equipment. So cash is going down. So in this transaction, we debit equipment and we credit cash. Now, keep in mind, if you didn't watch the previous video, or if you forgot because you're well versed in the banking world, debits and credits are reversed because the bank sees your account as a liability. So how we look at debits and credits changes a little bit. But from our perspective, cash is an asset. It is a resource that we own or control. So it does have a normal debit balance. We use a debit to increase, a credit to decrease. And keep in mind that debits must equal credits. Now we can formally record our transaction here. We list our date. The account that we're debiting goes first. So it's not always cash. Now in the last transaction, we listed cash first because it was debited. But in this transaction, equipment is debited. So we list equipment first. And the account that we are crediting goes second. It is indented along with the amount. And then we include our description where we purchased equipment for cash. Now let's look at another transaction. In this one, Cool Kicks purchased supplies on account for $2,500. So we have a new term here, and that new term is on account. Whenever you see the words on account or on credit, it means either an account's receivable or an account's payable, depending on who's the buyer or who's the seller. So if we are purchasing something on account, then we are promising to pay cash for that item later on at some point in the future. If we're on the flip side of that and someone is promising to pay us later on, then we've provided the service and we're looking at an accounts receivable. But in this case, because we are the purchaser, we are the buyer, we are looking at an accounts payable. So this time, my two accounts involved in that transaction, I'm getting more supplies, but on account lets me know that I'm promising to pay for this later on. So this is where we use accounts payable. For the next question, what type of accounts are we dealing with in this transaction? Well, supplies is an asset, but accounts payable is a promise to pay. So we owe someone, it is a liability. Now, next question is the normal balance question. What's the normal balance of any asset? Well, it is debit. We use a debit to increase, a credit to decrease. Liabilities fall on the other side or the right side of the accounting equation. So it does have a normal credit balance. So I'm looking at debit for supplies and credit for accounts payable. Now, again, that is not what I do in my transaction as of yet. I still have to ask myself what's going on in this particular transaction. So I have to get to question number 5. Now in question number 4, that's sort of a review to help you remember how we increase an account with a normal balance of debit and how we decrease an account with a normal balance of debit. And same thing for an account with a normal balance of credit. So we know that supplies has a normal debit balance. We're going to use a debit to increase, a credit to decrease, but we're going to do just the opposite for accounts payable because it does have a normal credit balance. We use a credit to increase and a debit to decrease. Now, for my favorite question, what's happening in this transaction? In this transaction, the company is getting more supplies. So supplies is increasing. We are also keeping track of what we owe. So sometimes when students see or individuals see accounts payable, they think, oh, I owe somebody some money. That's bad. That account is going down. No, remember, debit and credit doesn't mean good and bad. We are keeping track of who we owe. And when we promise to pay someone later on, we now owe them more money. So that account is increasing. So accounts payable is increasing as well. It's okay that I have two accounts increasing because one has a normal debit balance and the other has a normal credit balance. So in this transaction, we're debiting supplies and we're crediting accounts payable. Remember, debits have to equal credits, and they do. Now we can properly record or formally record this transaction. We list our date. The account that we're debiting goes first, and in this case, it is supplies, so we're debiting supplies. And the account that we are crediting goes second. It is indented, and we list our description or explanation. Now let's see another transaction. We're moving on in the date. It's now December 20th. We're fast forwarding time here, and the company paid $500 cash for utilities. In this case, what two accounts are involved in this transaction? I know cash is one. Now, cash is not always a part of every single transaction. Notice in the previous transaction we just did, there was no cash involved, but a lot of the transactions early on do include cash. So cash is one. The other one is utilities expense. Remember, you have to spend money to make money. And the money that you spend to help you generate revenue should be recorded as an expense. So if I am renting a building or if I have a building, in order for me to service my customers, I have to have some electricity. So spending money on utilities helps me generate revenue. That's why utilities is an expense. So my two accounts involved, cash and expenses. Now, what type of accounts are we dealing with here? Cash is an asset, but expenses, of course, it falls into that equity category. But we're listing this separately because remember, expenses have a decreasing effect on equity. And that is going to affect the answer to my next question, which is the normal balance question. What's the normal balance of all of these accounts? Well, assets have a normal debit balance. Expenses, even though they're equity and they fall on the right side of the accounting equation because they have a decreasing effect on equity, they do have a normal debit balance as well. So this time I'm dealing with debit and debit. Now, next question, how do I increase an account that has a normal debit balance? I use debit. How do I decrease an account that has a normal debit balance? I use credit. And that's what this question takes care of. So I know what I'm doing when I get to question 5, which is the infamous question where we determine what's happening in this particular transaction. And in this particular transaction, cash is going down. I'm using cash to pay for my utilities. There it is. Cash is going down. But utilities expense is increasing. So with utilities expense, we are going to use a debit for utilities expense. We're keeping track of how much we're paying out in utilities expense all period long. So we see our debits and our credits here. Keep in mind, debits have to equal credits. Don't forget that. As long as debits equal credits, the accounting equation remains in balance. So now we put a box around the items that we need. And this time, the account that we are debiting is not cash. It is utilities expense. It's not even an asset. So I don't want you to think that assets are always going first or we're always debiting assets, because assets aren't always increasing. Assets can decrease. It is the account that we are debiting that gets listed first. So we're debiting utilities expense and we are crediting cash. And here is our description: pay for utilities. All right, let's look at one more transaction. On December 28th, we have Cool Kicks providing services on credit for $2,500. Now we are making the assumption that this company is in the business of providing some type of service to its customers. So when we provide services, we are earning money. When we're providing services on credit, our customer has promised to pay us later on. Remember, we talked about the terms on credit or on account. So when a customer promises to pay us later on, we have the right to receive the money in the future. That right to receive is an accounts receivable. So the two accounts involved in this transaction, I'm dealing with the fact that I'm earning money by providing services. So we have services revenue. And we're dealing with the fact that the customer is going to pay us later on. They've promised to pay us. We have the right to receive it. And that right is shown as an accounts receivable. Second question, what type of accounts are we dealing with? Well, services revenue, of course, is an equity, specifically revenue. But accounts receivable, that right to receive is a resource that I own and control. I can dictate when the customer has to pay me. So that is an asset. Now, at this point, it should start to sink in that the normal balance of any asset is debit. That means we use a debit to increase, a credit to decrease. Equity, specifically revenue, has a normal credit balance. That means we use a credit to increase and a debit to decrease, which of course answers question 4. As you get familiar with analyzing transactions and going through these steps, what you'll find is that you will be able to skip certain questions. Like I just collapsed question 3 and 4 together. And that is because you're starting to understand this whole process in terms of debits and credits. And you'll get to the point where you won't have to ask yourself the 5 questions. You'll be able to immediately jump to, hey, I know I need to debit this account. I know I need to credit this account. But use the 5 questions to help you until you get there. So let's look at question 5, which is the best question ever. What's happening in this particular transaction? In other words, which account is being debited, which account is being credited. Now, accounts receivable, I'm keeping track of how much my customers owe me. So this account is going up. I'm debiting accounts receivable. Now, if I debit one thing, I know I have to credit something else because debits have to equal credits. So if you can only figure out one side of the transaction, at least you're halfway there. If you know half of it is debit, then the other half should be credit. We can confirm that this is accurate because we're keeping track of how much money we've earned, and the normal balance of services revenue is credit. So here we go. And remember, debits have to equal credits. So let's properly record this transaction. The account that we're debiting is listed first. Of course, I have to list my date first, but the account that we're debiting comes after the date, accounts receivable. for $2,500, and the account that we're crediting is indented and it's listed second, and we list our description.